I want to talk just a little bit about the inherent unfairness and what I think transpired with Silicon Valley Bank. And I come from the venture capital industry, and this is a statement against interests, and certainly a statement against the interests of some of my friends. But the business model of Silicon Valley Bank was to provide banking services to venture capital firms and to venture-backed companies. And if you think about the fundamental trade that was implied, and I would even say explicit in their business model, what they did is they offered highly beneficial financial products to venture-backed companies and venture capitalists in exchange for having a large number of deposits in your Silicon Valley Bank account, sometimes often exclusively. So a common practice, for example, was to say that you would provide a line of credit to a venture capital firm, but only if that firm put all of its money, 100% of its deposits, in Silicon Valley Bank. Or they would offer private jet financing and other goodies that are basically beneficial only to the very wealthy in exchange for having all of your deposits at Silicon Valley Bank. Now, given that that was implied in the business model of the bank, I think it's important that we use the term bailout, and I know that some of you don't like that term, but I think it's the only term that applies fairly here, because we, using excess fees on community banks all across the country, effectively chose to bail out the uninsured depositors of Silicon Valley Bank. Now, there are some outrageous examples there. I think one firm had deposits over $3 billion. Another, I think Roku had deposits of $500 million. But there were a lot of people, a lot of firms at Silicon Valley Bank that had deposits well over $1 million, well over $5 million. And what we did in practice was bail them out. I guess my first question, I'd put this to all three of you, and because time is limited, I'd like you to answer quickly, is what is the threshold? Whether you guys meant to or not, I think the implication of what happened with Silicon Valley Bank is that there are a lot of people who expect that their uninsured deposits are effectively insured at an unlimited level. Or if you're a banker, there's an assumption from a lot of people that at a certain level, if you're systemically important enough, your uninsured depositors are going to get bailed out. Maybe just go from left to right, starting with Mr. Greenberg, but at what level do you think uninsured deposits, in theory, are effectively unlimited uninsured in our banking system today?
Well, if I may say, Senator, you're asking important questions. I think we have a lot of lessons to learn from this episode. The decision to cover uninsured depositors at these two institutions was a highly consequential one.
Yes.
That has implications for the system. I think we need, and I indicated in my statement earlier, we need to do a comprehensive review of our deposit insurance system and consider the questions that you raised. The FDIC is going to undertake that, and by May 1, we'll deliver a report including policy considerations to take into account. So we want to try to be responsive on that.
Thank you. Mr. Barr.
I also think you raise important questions. When we were looking at the systemic risk determination with respect to these institutions, we were thinking about the risk to the broader financial system, not the particular depositors at one or two institutions. We're thinking about and concerned about the extent to which that could impact regional banks across the country, community banks across the country. We were hearing concerns from bankers and from depositors, from businesses around the country. It's a difficult judgment, but one that, at the end of the day, a unanimous FDIC board and a unanimous Federal Reserve Board of the Treasury Secretary agreed that risk to the system was not a risk that was worth taking. And so, today I think we can, say that the banking system is sound and resilient, and the steps we took demonstrated that resilience and the safety of deposits around the country.
So I'm less concerned with the decision itself, though obviously I have a lot of questions there. I think there's an open question about whether we could have provided the confidence to the banking system and the liquidity that was needed in case of a bank run without bailing out the uninsured Silicon Valley Bank depositors. I think that's maybe a topic for a follow-on hearing. But what I worry about is the fundamental unfairness here, that we've drawn a line, and I don't know whether the line stops at Silicon Valley Bank. Maybe it goes much further. Maybe it stops there, where if you're systemically important, which is a term that's impossible for anybody here to define with confidence, if you're systemically important, your uninsured deposits are effectively unlimited. in their insurance. Whereas if you're not systemically important, if you're a regional bank in Ohio, there's a very good chance that your uninsured depositors will not receive that bailout. And I think that uncertainty is a really, really big problem with what you guys have done. I'm not saying that in an accusatory way. I understand that there were reasons to do what you did, even though I don't think it was the right decision. I'm just saying I think it has some real moral hazard here. I know I'm over time here, so the one thing I'd ask here is just unanimous consent to introduce a letter to the record from American Share Insurance. This company provides private deposit insurance to most state-chartered credit unions, including the 43 in Ohio. And just on this point of moral hazard and on this point of unfairness, I'd like you guys to consider doing is extending the same implied offer that you gave to the Silicon Valley Bank uninsured depositors to do it a little bit further down the banking ladder so that everybody benefits from the rule that you guys have created for Silicon Valley Bank.